Hi, Larry Gaines, Power Cycle Trading. In this video, I want to show you an earnings trade set up for Netflix. So, trading is a business of probabilities, and option trading is really a business of probabilities. Plus, you can measure the probabilities. So, Netflix has earnings today. You can see this is it went out closed at 353. Okay, so the option models were telling us that the market was expecting Netflix after its earnings release today, Thursday, that it could the expected move up, that the probability was that it could move up 8%, which would be to 383, or down 8% to 323. So this would be a normal kind of one standard deviation range that the option market was given. So if you expand that, because Netflix has a tendency to have even bigger moves, this is like a two standard deviation move, 413 to the upside, 293 to the downside. All right, so if we look at Netflix past earnings, you can see they're huge. They can be very big up or down. So looking at its earnings history, this is like on an expiration. So, 1 day later, 3 days later. So you can see here 1 day later, Netflix has a tendency, it can move down 19%. 12% down, so it has potential for big moves. So with Netflix, it's good to, if you're going to do something like selling implied volatility crush, you want to sell as far out of the money to give yourself some high probability that it's going to work. So here's one opportunity or one setup that you could look at. So based on probabilities and options, if you were to sell a 413 strike call right here, that gives you, that's about what we call, that's going to be about a 5 delta, which would say that there's a 95% probability that price will close below 413. And then 293 would be the two standard deviation point to the downside, and that would be around a 5 delta too. So that would say that the market's expecting that Netflix would close 95% of the time above that. So if you could sell a short call credit spread, a short bull put credit spread here, then you've got a high probability. You've got a 5% better probability that that's going to be a winning trade. Not a 5%, but a 95% probability. So it's all based on the probability. So here's one setup that you can look at. Before we do that, though, here's what Netflix did after the announcement. So you can see Netflix here after the announcement here today. It didn't even make it to the one standard deviation or the expected move down so far. So it could tomorrow, but you can see here it's not even within the expected range. So it looks good for two standard deviations, will look really good. So here's one setup you could look at doing. So this is an iron condor credit spread on Netflix, and this is selling two standard deviations out of the money. So it's basically selling a 405, 410 call credit spread here and a 295, 290 bull put credit spread here. So all in this zone is max profit. So $51 potential profit, risk of 449, so 11% return. But the reason you would do this is because it's got a high probability, about a 95% probability that the price will close inside of these two, inside of this range here. All right, so I hope this helps. I'll talk to you on my next video update.